All right, guys, listen carefully. This is one of the most important parts of all of accounting. In my personal experience, there are three concepts, just three concepts, which, if you truly understand, the rest of the accounting will feel like common sense. You'll actually be surprised why some people call accounting hard. Because once you crack these three concepts, you will see it is all just extensions of the same logic. So, what are these three concepts? The first is what we are learning today, which is the buckets of accounting. The second, which we will do sometime later, is the accounting equation. And the third concept, which we will do also in the future, is called golden rules of accounts. If you properly understand these three, I would say that you have already understood about 70% of accounting. Does not matter if you are aiming to become a chartered accountant, an MBA, or even a PhD in accounting. The foundation is the same. This is the foundation. 70% of all of your accounting is just these three concepts. So let's start with the first one, the buckets of accounting, the five buckets of accounting. But before we get into the five buckets of accounting, there is one rule that you have to remember. That rule is called the business entity concept. It is basically saying business is different from businessman. That is it. It is simple. Okay. In accounting, the business and the business owner are treated as two separate entities, two separate people. Okay. Um, I mean, for a layman, it might look like the same thing. For example, in our examples that we've taken in previous videos, we've taken the example of Asha, who started a stall, right? Now, for somebody who's a layman who's looking from the outside, it would look like it's the same thing. She just put some money there. She started a stall. So, whatever loss is coming, she has to bear. Whatever profit is coming, she can enjoy. So, to him, it is the same thing. So, if he is giving money to the stall, if he's purchasing something from the stall, he will think that it is the same thing. I mean, I'm giving money to Asha. But in accounting, that is not the case. Look at it from the stall point of view. All right. For example, let's say Asha is starting this stall with 20,000 rupees. What is happening to this 20,000? It is going away from Asha, right? It is going from Asha. But if you look at it from the stall's point of view, the stall is receiving this money. So Asha is sending it, but the stall is receiving it, which this is a very critical distinction that you have to remember, right? Business is different from the businessman or business person or business owner. You, as an accountant, you will always write accounts from the business perspective. You will never write accounts from the owner's perspective. The business's point of view is what we will consider in when writing the accounts, not the owners. For example, in the same case, let's say Asha is using 20,000 to start a stall. The accounts you will write as if the business is receiving money, not as if Asha is spending money. Okay. Now that we understand the business concept, be very clear about this concept, please. So, if you understand the business entity concept, only then move to the further videos or move to the further concepts. If not, please rewind, listen to this again. Okay. The business is different from the businessman. Now that we've made it very clear, okay, let's talk about the buckets of accounting. I said it is very important, but luckily it is also very easy because there are only five buckets of accounting. Every single transaction in the world, no matter how big or how small, will always fall into one of just five buckets of accounting. Okay? It can be a company as big as Reliance, or it can be a company as big as State Bank of India, or it can be a business as small as a roadside pani puri shop or your local kirana store. All of those transactions for all of those businesses fall only in five buckets of account. Okay, let's talk about the first bucket. The first bucket is called assets. All right, assets are what the business owns and it can also use in the future. Like, these are some of the resources that the business owns that can help the business run in the future. For example, let's say in our stall example, Asha stall, okay, let's say the business buys a stove, right? The stove, who owns the stove? The business owns the stove because the business spent its own money to buy the stove, right? And it is owning the stove. It can be used in the future for cooking. So the stove becomes an asset. For example, the business buys chicken to manufacture chicken rolls, to cook chicken rolls. That chicken can be used in the future. Obviously, that is why they are making chicken rolls in the future. So that is an asset. Let's say to go and deliver in some part, the business buys a car. That car is an asset on the business's name. All of these are assets. Even the cash that is in the box, right? The cash that is in the counter, that is also called an asset for the business. See, here, notice I'm not saying this is what Asha owns. I'm saying this is what the business owns. It is a big difference. Okay. So, if you've understood assets, like for example, personally, forget business. Personally, what are your assets? You will have a house, right? Or you will have a car. All of these are your assets. All of these are what you own. You will have a bike, right? Or you will have stocks. All of these are what you own. Similarly, for a business, the business also has ownership of certain assets, like, in this scenario, cash stuff. Like, for example, let's say Reliance. Reliance has a lot of buildings. That is all assets. Reliance has a lot of machinery to refine petroleum. That is all assets. So assets are nothing but what the business owns that can be used also in the future. Then we can move on to the second bucket, which is liabilities, which is the exact opposite of assets. Liabilities are what the business owes to others. Like, this is what others own that the business has to pay to them. For example, the business borrows a loan from a bank. It has to repay it back to the bank. That is a liability. In our previous example, I said Asha took flour on credit. Asha took chicken on credit. She has to pay the money back to the chicken guy. She has to pay the money back to the kirana guy. This is all liabilities, right? Let's say the business has a stall. The business has to pay rent on the stall to the owner of the stall, right? So that is also again a liability. So basically, liabilities are nothing but all the promises that the business has to keep, the business has to pay in the future, right? Then the third bucket is equity. Some people call it also capital, okay? But there is a slight difference in terms of what equity means and what capital means. Sometimes they are the same, sometimes it is different. So to be safe, let's call it equity. All right. Equity is basically how much share the owner has in the business. Okay. So for example, in our example, Asha is the owner, stall is the business, right? Now, Asha put, let's say, 20,000 to start the stall, right? The 20,000 becomes her equity. But when the stall earns a profit, the profit is, let's say, 5,000 rupees. In total, Asha can take 25,000 back. So her equity becomes 25,000. Or if the stall makes a loss, okay, Asha's share in the business reduces. So equity is nothing but what is the owner's share in the business. It is basically saying this much belongs to the owner. Okay. Now we are done with three brackets. There are only two more. Sorry, we are done with three buckets. There are only two more buckets more. The fourth bucket is income. Okay. Income is nothing but the money the business is earning by selling goods and services. For example, let's say this stall sells 500 rupees of worth of chicken rolls in today, right? So that 500 is basically income. And it does not always have to be cash. Sometimes it can be credit also. For example, let's say uh, I sell or the business sells 500 rupees in cash, but there are five people who said, you know what, I do not have the money right now, I'll pay you later, I'll pay you tomorrow, right? That is also sales. Even though we did not receive the cash right away, that is also income. Okay, you still have to consider that as income. So income is whatever the business has earned, whether cash is received or not. Okay, if you receive cash, it is called sales. If you do not receive cash, if they say I will pay you later, then it is called credit sales. But essentially income is both cash and credit sales both. All right, please remember this, that income is not just cash sales, it can also be considered as credit sales. Now the last bucket is expenses. Expenses is like the exact opposite of income. It is what the business spends to keep running, right? For example, in our stall example, you have to buy, you have to pay rent. So I'm sorry, you have to pay rent for the stall. You have to pay electricity bill. You have to uh, you have to buy flour. You have to buy chicken. You have to buy oil. You have to pay salaries. All of these are expenses. Okay, so if you want to recap, there are only five buckets of accounting. First bucket is assets, which is what the business owns. Second bucket is liabilities, which is what the business owes. Third bucket is equity, which is essentially owner's share in the business. Fourth bucket is what the business earns, which is called income. And fifth bucket is expenses, which is what the business spends. So every transaction will always fall only into one of these five buckets. That is why if you speak to like accountants whose job it is to write accounts, they will say accounting is nothing but just sorting into buckets. If you understand this concept, you are on your way to becoming a pro. All right. So let's move to the next concept. Okay. So let's start off with the accounting equation. Like I said before, this is one of the most important concepts you can learn. The first one we've already covered, which is the five buckets of accounting. The second most important one is the accounting equation, right? So there is a simple rule which we call the accounting equation. Everything else builds on top of this, okay? And the equation is assets is equal to liabilities plus owner's equity. Okay, please repeat it with me once. Assets equal to liability plus owner's equity. This must always balance. And if you find it hard to remember, you can just remember the word ALOE, aloe, like your aloe vera. Okay, so this is the big rule. Now, before we talk about accounting equation, before we go into depth with it, we need to pause and really understand what exactly is equity, right? What does equity mean? I said it is a part of the bucket, uh, but what exactly is equity? Equity is not capital. Capital and equity sometimes can be the same, but not always. So let's understand this slowly. All right. Equity is essentially what an owner can claim from the business. For example, let's say Asha started her stall with 20,000 rupees of her own money. That is her capital. Money given to the business in order to start the business, right, is called capital. So Asha gave capital of 20,000 to the stall, right? That is the money she has invested into her business. Now let's say within the first week she makes a profit of 8,000. Here's the question, think about this. How much does Asha own in her business now? How much can she take from the business? She put 20,000 in. She also has a profit of 8,000. So she can take 28,000. Yes? Basically her original capital plus profit. Where did this extra 8,000 come from? It is not some outsider's money. It is her money. It came from the business making money. So it belongs to the owner, right? It is not some liability. It is not a loan. It is a profit that the business made, right? So it belongs to the owner. Now, let's look at the other side of it. Let's say the week after that, things did not go well, right? She spent 6,000 but only earned 4,000. The business spent 6,000 but only earned 4,000. That is loss of 2,000. So it was 28,000 before that Asha could take from the business, but now there is a loss of 2,000. So how much is left now? She can only take 26,000 now, right? That is her share. But you see how if you get a profit, her share increases, and if you get a loss, her share decreases. That essentially is equity. There is one more component to it, which is called drawings. I said capital is something that the owner puts to start a business. Drawings is the exact opposite. Drawings is money or goods that the owner takes out from the business for his personal use. Like, for example, let's say one day Asha is sitting in the stall. She urgently had some personal expense, right? She maybe, uh, I don't know, wanted to buy a new sari, right? Now she takes 1,000 rupees from the business. It is not business expense, it is her personal expense. So if she's taking money from the business for her personal expense, that is called drawings, right? That is basically she's taking her money out. Okay. So in case of a drawing, then also equity reduces. It used to be 26,000 before. Now because she's taken 1,000 rupees, it's only 25,000 now. All right. You see the pattern here. Equity is just the owner's share in the business. In our example, how much belongs to Asha after paying everyone else? Okay. So simply put, the formula for equity is equal to capital plus profit or loss minus drawings. Now, you all know the formula for profit or loss. How do you calculate profit or loss? Income minus expenses. So, equity is nothing but capital plus income minus expenses minus drawings, right? Start with what she invested, add what the business earned, subtract what the business spent, and subtract what the owner pulled out for himself or herself. That's it. It is very simple. The once you put this all in a formula, whatever amount you get, that is the equity. That is the owner's stake in the business, right? Now, if we go back to the original equation, I said assets is equal to liabilities plus equity. And I said it should always balance. Now, why should it always balance? Right? Think about this. Let's say in the same stall, Asha wants to buy a stove. Stove is an asset, right? Asha wants to buy some asset, any asset. It can be a stove, it can be a car. Where is the money coming from? I'm going to hold on for, I'm going to stop for like 5 seconds. Close your eyes. Think you are the business. For the business, you need a stove, you need a some asset, you need a car, right? Where is this money coming from? Right? So either the money is coming from whatever the owner has given, right? So, for example, Asha has put 20,000 in that stall. To buy a stove, it costs 5,000, let's say. So, either the business is taking money from the owners, from whatever the owner invests to buy that asset, or the business is taking a loan from a bank or from some outside creditor to buy that asset, right? But in order to buy that asset, there has to be money. The money has can come only from two places, either from the owner or from some outsider who is lending the money to the business. If the outsider is lending, it becomes a liability. If it is owner who is giving the money, it becomes equity, right? That is why there is no third source. That is why whatever the business owns, whatever the asset of the businesses are, must be financed by either outsiders or equity, which is why the equation will always hold true. Assets is equal to liability plus owner's equity. Always. Okay. I hope this is clear. Now, we know what equity means. We know what the accounting equation is, which is assets is equal to liabilities plus equity. We know why it should always balance. But how does an accountant ensure that it will always balance out? How does how does that work? Right? Why? The answer is simple. Because of a system called the double entry system. It means whatever transaction that takes place, like buying a car, buying a stove, paying salaries, nothing, anything, right? Nothing is exempt from this. Any transaction that takes place, it will affect two places in the accounts, at least two buckets in the accounts. Nothing ever happens alone. We will go into it in depth. All right. And once you see the examples, you will clearly understand why this is happening. Okay. But remember, double entry system is essentially when every transaction affects two accounts or two places in the accounts. Okay. So when one side goes up or when one account goes up, the other account either goes up or goes down, but there is a corresponding change. All right. So for example, let's take a look at the owner putting money to start a stall. Okay. Now, if Asha is putting money, 20,000 rupees of her money to start a small stall, okay, 20,000 is cash. Think from the point of the business, because we've already agreed and discussed that we will only write accounts from the point of the business, right? For the business, 20,000 rupees is coming inside. It is cash. That is an asset, correct? So asset is going up. But similarly, 20,000 is what Asha is giving the business. 20,000 is something the business has to pay back to Asha, right? And because it is the owner, it is called equity. So equity is also going up, correct? Let's say the bank takes 10,000 rupees as a loan. I mean, the stall takes 10,000 rupees of loan from the bank. 10,000 cash is coming in, assets are going up. But because it is an outsider and it is a loan, the liabilities also will go up in the business accounts. Let's say um, the let's say the stall buys a stove, right? It has to buy a stove. Stove is an asset. So assets, let's say the stove is 5,000 rupees. Stove is an asset, right? Cash is going down, but an asset is being added. Cash is going down by 5,000 rupees, but asset is added, which is the stove, for the same price. No change in liabilities, no change in equity, but still the equation is balanced. Let's say the stall needs some chairs for the customers to sit, right? Furniture. But this time they did not pay with cash. They bought it on credit. They said we are buying now, but we'll pay the money. I mean, the business is saying we are buying the furniture now. We'll pay the money next month. This is credit, right? So assets is going up because we are getting furniture worth 8,000 rupees. But on the same side, on the other side, liabilities are also going up because now you have to pay the 8,000 next month to an outsider, right? Let's say you earn or the business earns 2,000 rupees for chicken rolls. Cash is coming in, asset is going up. But on the same side, equity will also go up because income is going up, right? Let's say you're paying a salary to the helper, 1,000 rupees. Cash is going out, assets are going down, right? But on the other side, equity will also go down because any expense will reduce the equity, right? So these are some of the examples. I mean, we could discuss a lot more examples. Let's say drawings. Let's say Asha takes out 2,000 rupees from the cash box from the stall, right? Cash is going down, so assets went down. But on the same side, equity will also go down by 2,000 rupees, and it will again balance. Okay. So this is essentially what the accounting equation is. It is very simple. If you understand, I will put a list of questions now. Just try and answer as many as you can. In case you're not able to answer any questions, please seek clarification. Do not move ahead until you clear this concept, right? Just the last concept, which is five buckets of accounting plus accounting equation. If you are clear with these two concepts, 50% of your accounting journey is done. So do not move ahead unless you are very clear with these two. Okay. So as you see, every possible transaction, it can be owner's money, loans, purchases, sales, expenses, repayments, drawings, anything, always affects at least two buckets. That is the beauty of double entry. No matter what happens, the equation assets is equal to liabilities plus equity will always hold true. Okay. Thank you.